Hello and welcome to Securities Lending Saturday. I'm your host, Roy Zimmerhansl, and today I'm going to be taking you through part two of ESG and securities lending. So, if you're an institutional or retail investor, whether you hold mutual funds, ETFs, stocks, or bonds, or if you're part of the securities lending ecosystem, then this is the place for you. So, let's get to it. Hello, everyone. Welcome to another Saturday. I will bring up my slide deck so we can get straight to it. This is part two of securities lending and ESG. Welcome, everyone. And hello to our usual viewers and visitors. Let me just say hello. I've got someone again from LinkedIn, so I'm going to guess it's V because V is almost always first. So let me know if that's you, V. If that's not you, just let me know who you are, and thanks for joining me. And this is what we've been talking about over the past 23 weeks. We took 1 week off because of technical problems, but it's 23 consecutive Saturdays that we've been talking about. And as you can see, we've talked about just about everything on securities lending. And this week, it's part two of ESG. So thanks for confirming that, V. Hope you have a great Saturday. So this week, ESG part two, but next week, we're going to shift to emerging markets and securities lending. So what I want to do is maybe over one or two videos, what I'm going to do is look at why an emerging market would want to introduce securities lending, some of the challenges and obstacles that they face, and how they might overcome them, and why, interestingly, they want to add it in. Everyone's always surprised when we see short selling bans that new markets would actually be actively encouraging the implementation of short selling and securities lending that supports it. So we'll talk about that, as I said, next week and possibly the week after. Okay, Fanny, hello. Thanks again for joining us. Another great regular viewer. I really appreciate you spending the time here and making your comments. So the thing that we're going to be talking about today, this aspect of it, is about choices. So last week I talked about the big picture, the overview, some of the key fundamental issues. Today I'm going to talk about the choices that people have when engaging with securities lending as it relates to ESG. And spoiler alert, there are no firm, hard answers on this. These are all individual choices, which is great because you exercise control. It also, as we transition, I think it's the kind of thing that throws up challenges for the service providers, because the service providers, really their objective is to streamline, automate, and get scale in all of these activities. So the more individual decisions there are by their underlying clients, the harder it is to aggregate people into similar groups and achieve that scale. Fundamentally, though, the assets belong to the investors and they are borrowed by the end user, usually a short seller, but not always. And those are the two entities that have to be satisfied. And it's a challenge for securities lending and securities lending providers to meet those challenges. So let's talk about what these are. We're going to look at counterparties. We're going to look at the lendable portfolio, and we're going to be talking about collateral. So that's the agenda. What I want to first do, though, is really introduce this. Many of you that have done economics will be familiar with the invisible hand. And what that really means is free market activity will give investors and market participants really across the board the opportunity to make choices. Some of us choose Coke Zero. And if enough people choose Coke Zero, it'll be a successful product and will grow, right? People are voting with their money. Now, what's the beneficial aspect of that? If you're going to drink a soft drink, maybe you should be drinking a soft drink that doesn't have sugar, like Coke Zero. And that's possibly the worst example of the invisible hand, but I hope you get what I mean. The idea is that by acting in your own self-interest, if everyone does that, there can be an efficient allocation of resources, as it says, for the whole of society and directed at things that will actually benefit society in general. That's the idea of the free market is obviously the opposite to a planned economy, which is what you would see in communist countries where there's central control that dictates what is allowed, what isn't allowed, and has a plan, as the name suggests, for where assets will be allocated, irrespective of whether they have an economic benefit. They consider in the planned economy that it's part of the central planning, and they can decide what's best. So I look at ESG as being very much the same for securities lending and ESG generally, because it's about right now, there are guidelines, there's suggestions, there might even be a few codes of conduct, but there are not really hard and fast rules in most places for most aspects of it. And so the choices and decisions that investors are taking today and companies for their own agendas, to the extent that they're taking account of ESG considerations, that's a proactive move towards benefiting society. Now, everyone has their own self-interest. So companies want to continue to be able to expand and make a profit, and they want people to continue to invest in their shares and become customers of theirs and keep them as customers. So these things aren't incompatible. They can want to have a strong economic positive outcome from positive ESG actions, attitudes, and plans, so that they're not inconsistent. Okay. So just want to leave that. And the same thing applies to securities lending, because to the extent that people are complying with constraints, restrictions, filtering, making choices, that's voluntary for the large part right now, and voluntary with a view to making it a better society. And here's an example. So the PRI was set up by the United Nations, and there are signatories that follow the various guidelines and best practices, codes of conduct. And one of the things, this is a brand new video over the last couple of days, where they're talking about embedding those ESG factors into investment management mandates. Okay. And many of the signatories to PRI are in fact investment managers. So really, this is all about trying to end the considerations and the filters and the questions and the views of ESG related issues into the wider investment activity. And my argument is that securities lending is part of that investment ecosystem, and therefore needs to reflect in exactly the same way the kinds of considerations that investors do on the front end when trying to decide what to purchase or sell. But I call it the invisible hand plus, because it's not like there isn't any government interest or intervention here. So here's just a few examples. So the European Banking Authority has put something together about ESG risk management and supervision. They are responsible for regulating banks. So they're saying, look, there are ESG risks and they are important, and they are beefing up their focus and attention to the topic. So that's one example. The middle one here, that's from the OECD, which is talking about a lot of the challenges. It's really quite a good paper. It lays out where we are today and what the challenges are in moving forward into a better, more sustainable environment. Earlier this year, the US Securities Exchange Commission announced a task force focused on climate and ESG issues. I think that was less of a focus with the last administration, certainly a bigger focus for this one. And then even this up here in the upper right-hand corner, that's the Network for Greening the Financial System. And it's really an organization, a voluntary organization of central banks and supervisors who are examining how to help push, drive, force, cajole, whatever, the financial sector to be more cognizant and more aware of ESG issues for the financial system, but focus more on the green aspect of it. Now, in the last video, I talked about the different aspects. So there is an E, which is the environmental, which is green. Then you have S, which are more the social factors. And then you have the governance factors, right? And there are different focuses by individual firms, by regulators, by regions, and by organizations. So always be aware of those kind of biases. Now, one of the reasons why it's challenging is across those three areas of environmental, social, and governance, there are different criteria. So this example from that OECD report, what it's actually doing is highlighting three of the big index providers and what those index providers each consider within their rating system and approach. So that just gives you a perfect example of how just across three different entities, there are different components. And some of it's subtle. Many of these things are similar and they're just worded differently. Of course, they're commercial competitors, so they have to word it differently. But there's no question that there are different aspects considered within each of those indices. So you can have a company that is rated highly by one, less highly by another, and even less highly by a third, all purporting to put in an ESG rating. And so that's the challenge that we face today. I hope these videos are helpful. I love making them, keep getting more subscribers. So that's a good sign. And I get a lot of great repeat visitors, as I've mentioned earlier today. And people generally say nice things, although there's a really weird comment that came in last night, actually, from a viewer. My advice to you is see a medical professional. But anyway, if you like this, please give me a thumbs up. If you want to see more, please subscribe. And if you ring the bell, you even get notified every time I put up a video, which is usually about 3 p.m. on Sundays, UK time. Okay. First point, counterparties. So why is it important that you choose who you deal with? Many of the aspects of ESG is about encouraging and directing and kind of support for organizations that are either ESG compliant or improving their approach and attitude, policies, and practices towards becoming greener. So by choosing to trade with a counterparty, that is generally speaking supportive of their business efforts. And the idea is that if enough people support them, that will encourage them to do more, do it faster, do it better, do it deeper and wider, and they will gain a competitive advantage over those organizations that don't. Now, look, we have to be honest here. Securities lending is a low risk business, which I've talked about, not a zero risk business. But in terms of counterparty selection for securities lending, differentiating by ESG factors, like that's really a medium to long-term risk management decision. I don't really think that's choosing between counterparty A and counterparty B has an immediate or dramatic impact. This is much more about being part of a bigger picture, which encourages organizations to act properly. But the idea is that unless organizations have a sustainable business model, they will go out of business over time, or they become less profitable or less desirable to deal with. So think of it for securities lending purposes as a medium to long term. But what I really think it needs to do is securities lending is only one activity. Institutional investors, whether they're long investors or short investors, they deal with multiple service providers. And to the extent that they're differentiating between service providers based on ESG criteria, what I think is whatever those decisions and criteria are at the front end, they should equally apply for securities lending activity. So in other words, it would be odd if a firm wouldn't deal with a bank to be one of their transaction counterparties for buying or selling assets or foreign exchange or getting into derivative transactions. We don't want to deal with them there, but it's okay to deal with them in securities lending. I think that if the reason that you don't deal with them is because of ESG purposes, then it would seem strange to me that you're just going to discard all of that and say, yeah, but it's okay to lend them secured. So that's really what I mean by aligning with overall service provider criteria. What I did just to get some kind of a sense of the exposure on ESG for securities lending counterparties on the borrower side, what I did was I looked at two things. So there's a company called Sustainalytics.com, where they provide freely available information on their ESG ratings. And I think Sustainalytics is part of Morningstar as an organization, but I just think that's correct. I'm not 100% certain. And what I did was I used their ratings and I looked at investment banks that are securities borrowers. And what I did was I took the top 20 borrowers that were from the ISF surveys. And what I did was I just looked them all up. I went, okay, it'd be interesting to see for all of those major organizations, how are they rated from an ESG perspective according to this one organization? And so I came up with, out of that 20, basically there's 17 firms in yellow. They were classified as medium risk ESG firms. There were two entities that were classified as low risk. They're both Canadian, just saying. And there was one entity that was rated as a high risk from an ESG point of view. And I didn't really, obviously, the free information is limited. My guess is that it's a governance question more than an E or an S. But again, I could be wrong with that. So just to give you an idea, broadly speaking, what we're talking about is, even from an ESG perspective, the group is a safe group of counterparties. And I just thought I'd add this in. This is just an example of one of the rating agencies. Fitch has a learning aspect to their business. And the headline here, the intersection of ESG and credit risk hidden in plain sight. What it says to me is that rating agencies themselves are looking at ESG as being a criteria that they use to differentiate between credit risk for counterparties. So something to be aware of. It's not just me making it up, and have a look at it for yourself. See if you agree. Now I want to move on to the portfolio itself. So the question here is, should investors actually, having filtered their portfolio investment decisions based on ESG criteria, should they really make them available for loan? And there's two ways to look at it, because this is all about choices. One of them is no. The investors, when they get that portfolio, they've chosen them because they want to support those companies' ESG initiatives. So why are they going to all of a sudden say, oh, you know what? We've gone through this process where we've filtered out all of the bad ESG actors, and we've now got this great portfolio. Why would we give those to short sellers so that they can attack those companies? And remember, last week I asked, would you like me to do a video at some point on short selling itself? I've had a few people say yes. It'd be interesting to see what the rest of you think. So if you think you'd be interested in seeing me do a video specifically focused on short selling, then please put a yes or a no, or whatever comment you'd like to make, into the comment section that on whatever platform you're watching it on, and I'll take decision. But you can see that thinking. I've got a great portfolio. I really like all the companies there. I am not going to give them to somebody else who's going to short sell them and attack them after I've gone to all this trouble of getting the right portfolio in the first place. So that's the no version of it. But let me just give you the yes, because everything is choices. So number one, just because a company says that they have a transformation plan that's going to make the organization more sustainable on one or more aspects of the business, doesn't mean they're going to do it. And if they already are doing it, it doesn't mean that they'll actually continue doing that. And as time moves on, maybe what looks like a good plan today is not such a good plan tomorrow. And so short sellers are the key guardians, I think, of greenwashing, right? Where companies talk about one thing and do another. And so short sellers, of course, need the securities to be made available to them to short sell. And look, the truth is, long investors don't always catch these entities. In fact, it's very difficult to catch fraudsters. And that's why short sellers and journalists, investigative journalists, have such a hard battle when they try to out companies that are misleading or fraudulent or making questionable claims intentionally or unintentionally. It's a difficult job to do. And so they need to have access to portfolios, number one. I guess the second point is, if you really think that you've bought this portfolio for a long period of time, then what happens to the stock price today or tomorrow or over the next month shouldn't really matter, because you've already made your investment, and your plan, based on your selection of that investment, is to hold it for an extended period of time. So if you're making money while you're getting to this longer term time horizon, maybe that's pretty good for your stakeholders, right? So there are trade-offs here. And just because someone short sells it doesn't mean they're right. Right? Like, the best example of that is, irrespective of which side you're on the Tesla argument, the truth is Tesla's share price has gone up. They have created incredible value for shareholders of that company. Whether it's sustainable or not is just a point of view. Some people think it is, some people don't think it is. And the ones that don't think it is are paying a heck of a lot of money to the investors that do think it's a good thing. So the two do fit together quite nicely from that point of view. And Tesla is perhaps the most extreme example. And then the final point there I just want to make is that, remember, most shorting is not for long term directional trading purposes. Right? Most of it is hedging portfolio risks. So some of the big name stocks, the Apples and the Microsofts and the Googles and Facebook, sometimes they get shorted as a proxy for the rest of the market because the shares are widely available, they're cheap to borrow, and they have such a disproportionate influence on how the main index performance runs, that by shorting them, you can very inexpensively cover yourself on the market. So that's not about whether Facebook's going to drop. There's other reasons why you might think Facebook is going to drop, but not for these kind of portfolio hedging trades. So that's part of it. Some of it is pricing differentials, right? So you see a lot of statistically driven models that say there are correlations and relationships, and when they get out of whack, you expect them over time to converge to their historical pricing relationships. And so again, they don't really care about the companies themselves. It's more about price performance. So the directional short selling of, I'm going to short this stock because it's going to go down, that's a very high risk strategy, and it's a very small proportion of the business. So by not making your portfolio available, you are actually, number one, depriving yourself of revenues that for an activity that won't have any kind of long-term impact, because those prices will always converge. Number one. Number two, you are depriving yourself of the fees because you have a different opinion than someone else, and somehow you think short sellers are smarter than you, I guess. I don't know. And the third thing, of course, which is more of a holistic point of view, frankly, markets are less liquid without short selling. And that's why regulators and exchanges and market participants like having short selling involved, because it does improve trading activity. So again, choice is yours, yes or no. Those are the kinds of things I think you should think about. Just a quickie, this is just a rehash from last week. And again, what I'll do is I'll include a link to last week's video here, or wherever it shows up. I'm always amazed at the YouTube people who go, well, I'll just link you back to my video last week. It's right there. I still haven't figured that out. Maybe I need an editor. Okay, short selling and ESG. Look, I think at the end of the day, without repeating everything I said, I don't see how the whole ESG investing thesis can be entirely effective without active participation of short sellers, as I said, to keep companies honest. And that's both the companies themselves as investments and investment managers that create products that are ESG focused. They also need to be challenged and tested to make certain they're delivering investors the types of products that the investors think they're buying. Okay, so that's that. Having done counterparties and making portfolios available or not, the third part of it is collateral. Why should ESG influence your decisions on collateral? The first point says it all. The lender of an asset that takes collateral in becomes the legal owner of the collateral that they hold. The securities they've loaned out, remember, the borrower of those securities is entitled to do anything that they want with those securities that is legal. And so the legal ownership has actually transferred, but they maintain contractual ownership through their agreements. And it's the same on the flip side with the collateral. If I lend out a stock and I get the collateral, that is my collateral, and I can do anything I want with it. Most people don't, to be fair, but they could if they wanted to. And so if I'm the owner of that asset, And as I couldn't buy it as an outright investment. So my portfolio manager that runs the fund that I do the lending for, if they can't buy it, I don't see how that squares with the idea of me taking it as collateral and becoming an owner that way. If I can't own it on the front end, I don't see how I can own it on the back end as collateral. I'd be interested to see if anyone has a different view. So again, if you don't agree with that, put that in the comments. I'm interested to hear what you say and why you say that. Okay. So those are the two main criteria. And again, as a medium to long term impact of taking something as collateral, it's really about the financeability. I thought I made that word up. I haven't. It's actually, I've looked it up and it's a real world. The decisions on financeability of an asset have an impact on the company. So, as an example, an issuer, a bond issuer, where they know that bond can be used to as repo collateral or as securities lending collateral or be able to be used for derivative collateral or for central bank financing, those issuers don't have to pay as high an interest rate on their coupons as issuers that don't have that kind of utility of the asset afterwards. So again, this is not an overnight thing. This is something that says this issuer, to the extent that they tick all the boxes on ESG, whatever all the boxes means, their assets should have an advantage over time corporately, and that economic benefit should pass through to the company. But again, that's a medium term to long term objective. Most importantly, I think, is if there is some unexpected downgrade or bad news relating to an ESG related issue, it almost certainly is going to have a negative impact on the price of that collateral, or the price of the security given or taken as collateral. Now, again, that's not a problem if your counterparty is still in business, because the obligation is, well, look, I took this bond as collateral or this stock as collateral, but they just had a big blow up. I'm not interested in that anymore. And you say to your borrower, I need you to substitute that collateral for something else I take. So as long as my counterparty is still in business, that's no longer a concern. So these short-term blips shouldn't be a problem. But what if that problem, that downgrade, that bad news item that drives the price down coincides with another Lehman default? Well, now not only do you have normal market impact, when a counterparty goes out of business, markets almost always crash. So you would have that market crash. And then on top of that, this impaired asset might fall even further than it might otherwise have done. And that might expose you to a risk of loss. Okay. So all of these things you need to take into consideration when you are putting together your collateral portfolio. Now, I just want to touch on that pledge point. So pledge collateral is a different legal construct of how collateral moves and is held. So in most securities lending transactions, the securities on loan go out as a transfer of title. Like I said, if I'm the lender, I'm giving up the legal ownership to whoever the borrower is, and the borrower is giving up legal ownership of the collateral to me. Okay, so that's how normal transactions run. And for various regulatory reasons, that's disadvantageous to a borrower. So there's this pledge construct or pledge legal agreement or way to transact the collateral on under a different contract where it's a pledge. So the lender, I still lend out my securities, I still get other collateral in, but rather than it being legally my asset to use, I actually just have possession of it, so that if my counterparty goes into default or fails to live up to the obligations of the contract, then I'm allowed to take it and have it become mine and do what I wish to do with it. Okay. So I wanted to make that point because sometimes people think then I did this ESG collateral thing that doesn't really apply if I take pledge. I argue it does, because you may end up being the owner of that asset. So why would you take any different approach to situations where you definitely are owner of the asset? What are you hoping that it'll never have a situation? Lots of people hoped Lehman Brothers wouldn't go out of business as well. they weren't all that. Okay. And one other thing, which I just want to throw out there as something to consider, is this chart shows the cumulative issuance of green bonds in 2021. And I got it from climatebonds.net. And you will see that the 2021 issuance of $359 billion compares quite favorably with the 2020 total of 297. So it's definitely becoming a bigger trend. Now, the reason I wanted to highlight green bonds is one of the things you have to think about is when I have collateral, one of the most important criteria for me has always been my ability to sell that asset as collateral in the event of a counterparty default. And so I'm always looking for the most liquid assets. Now, green bond, irrespective of the ratings, because ratings have nothing to do with market liquidity. It's just about assessing the promise of the issuer to pay the money back and pay interest payments throughout the life of the issuance. So it doesn't talk about the liquidity. And green bonds have lower turnover than many other instruments that I could take as collateral instead. So why might I want to consider that? If I'm an investor, again, on the front end, and willing to buy green bonds, then maybe I'm willing to take these somewhat liquidity challenged assets at times and take that as collateral, because if my counterparty defaults, maybe I won't sell my collateral to buy back the asset I loaned. Maybe I'll just take these bonds onto my portfolio because it's consistent with part of my portfolio allocation decision. So I don't know how frequently people think of it in that way, but I'd like you to take this away and put that into your thinking box. And again, I'm interested to hear what you think. Should I trade off liquidity for support for green bond issuers? Question for you. And then finally, one of the challenges that, or perhaps the biggest challenge that ESG faces, is that it is going to be a long time before there is any kind of consistent, harmonized regulatory guidelines or actual rules that are in place. So the question is, do I just muddle along today and ignore it? Do I just guess along the way as to what the best way to do it is? Or do I try to make it better kind of day by day? Am I thinking more about ESG and applying it to my portfolio management and post investment activity? Am I doing that sufficiently today? And am I doing it better than I was last year or another or last month or last quarter or what? So what are your time frames for measuring that? And so I think that's what you have to do. And as with the outright investment itself, I think people are moving forward. And so expect securities lending and ESG to become an ever increasing issue, because as the front end moves forward, so must the securities lending aspect of it move forward. You've heard me talk, if you've watched this before, I'm a member of the Global Principles for Sustainable Securities Lending. These are just three of the work streams that I focused on. One is about general engagement, governance, and stewardship. One is about short and long activist investing, because again, these are the ones that are scouting for companies doing wrong things. So it's important that they have a voice in this as well. And then sustainable markets, sustainable securities lending, emerging markets, all of that is about setting up a pathway to make certain that ESG becomes embedded in activities of developed markets or emerging markets. Interestingly, often it's easier to implement higher standards in new markets as they begin, rather than try to change the investment practices and the operational procedures and processes of established markets, because it's such a big change and people are generally resistant to change. So some ways emerging markets have an advantage, and I'll talk about that next week. Now, before I have moved off of collateral, but let me go back. There's been a question from Asher. Hi to you as well. So the question is, let me just put that up there because I think it's a great question. Is only non-cash eligible to be used as pledge collateral, or can cash also be used as pledge collateral? So look, that's a great question. Effective cash becomes fungible, so you can't really carve it out. You need to actually do effectively a transfer of title. So the holder of that cash becomes the owner of the cash. So that's part of it. The other part is just practical. When I receive cash collateral, I need to do something with that. I can't just sit on it. I can't just let it sit in my bank deposit account because it needs to generate some income, because the borrower who's given me that cash expects some kind of a rebate of a share in the investment returns from the deployment of that cash. So it can't just sit there. And the only way that I can actually do something with the cash is if I become the holder of that cash that can action it. And so securities that I have as pledge, they just sit there. I can't do anything with them until or unless a counterparty defaults. With cash, I have to do it. So I can't set it up in a way where I'm just as sitting long. Okay. So hopefully that answers your question, Asher, but thanks for asking. It's a great question. And yeah, absolutely. Change is difficult. People don't like change. People like it. I believe generally people go to work to try and do a full day's work. I don't think that people feel comfortable with change. I think it disrupts their day-to-day routines. And perhaps the biggest constraint is people don't know what the outcome will be after the change. If you're doing well, if your company's doing well, if your clients are doing well, and change comes and they end up not doing so well afterwards, or your company does, maybe you should have avoided that change. I can see you thinking that. And so if I'm not certain what the outcome is going to be, why am I going to volunteer for change? Which is why quite often any kind of innovation or fundamental change is driven by regulatory imposition, right? So regulators say you're going to have to report your securities finance transactions to us as regulators in Europe. So a huge amount of time and effort and technology spent and an incredible amount of brain power went into how do we roll this out in as efficient and effective way as possible. I think it's been a tremendous success from that perspective. But look, there's a lot of people that are reevaluating their business today, right, based on things they've learned as a result of that. And I'm sure that's uncomfortable. Change is difficult. So people tend to avoid it. Okay. Oh, sorry. I just wanted to show. So these all of these things are work streams from the Global Principles for Sustainable Securities Lending. Here's the website for that. And recently they announced a number of opening signatories to that. Here's the current list. So those organizations have all agreed to sign up to the principles. There's many names that you'll actually recognize from being part of the securities lending business. Many organizations also that are short activists. And you'll also see data providers there and other interested stewardship governance entities as well. So it is and investors, of course. And so this is what the entire objective of it is. This is not about trade associations. This is about trying to capture the widest possible community for input, advice, and commentary. So my advice is, if you want to help shape the future of this, dive on in. We're always looking for people to contribute. Okay, just a quickie on the course again, just the 3 courses, the free course, the primer. We've had a bunch of people sign up again this week. I'm in the midst of recording this upper one. So that's what I'm going to be doing tomorrow, is recording more of those lessons. And of course, we have the big daddy of the paid for course. So that's a paid for course. This is a paid for course, but this one comes out with continuing professional development credits as well. And that's how you can learn more about securities lending, where we go into a lot more depth. And of course, you can ask questions and things as well. So to summarize, we're talking about ESG and securities lending choices today. We talked about counterparties. And my advice there is that it should be consistent with your overall service provider criteria. It would be odd if you had the same test for organizations at different aspects and different parts of your relationship and came to different conclusions. The lending portfolio, if an investor is satisfied with the risk reward criteria, then I really think that by making the portfolios available for loan, it's actually a positive move towards making markets more sustainable and meeting ESG objectives. And finally, collateral, again, the collateral that you end up holding and owning should reflect what you'd be willing to buy as outright investments. And if you follow all of these recommendations, then what you'll actually have is a scenario that at least is consistent from front to back. may or may not be right. That comes down to your individual choices. But frankly, what I'm saying is you will have something that is consistent and justifiable to any of your stakeholders, any of your regulators. You can say, this is why we do it this way. And if you can't do that today, then I think you have work. Next week, as I said, we're going to be doing emerging markets and securities lending, one of my favorite topics. So I might turn that into 10 videos, who knows? But until then, I want to say thank you very much for paying attention again and participating and viewing and commenting, and some great questions and comments today. Again, thank you very much for that. The full edited video with all the links that I've been talking about, that'll be available in maybe just over 24 hours. So that'll be Sunday, the 17th of October, about 3 p.m. BST. And of course, British summertime is coming down to its last few days and will be expiring at the end of the month, I think. So BST will have to change and we'll go back to GMT. But until then, have a great Saturday. Have a great weekend. Have a great week. I hope to see you next Saturday. Thanks for watching.